Hello, I'm MaryAnn. The huge 45% drop in oil prices will help you at the gas pump, but it's hurting the energy companies in your portfolio, and there could be more pain to come. So how do you position your investments? Thomas George, portfolio manager of the TD Resource and Energy Funds, is joining me. Thomas, we've seen a huge drop in oil. Where do you see it going from here?
Yeah, so there's a multitude of pathways, and we've been in a focused, it's been downward, and it's of significant velocity. I would say one thing, we're in an air pocket of fear and speculation, and that is, that typifies what happens in commodities when things start to get disjointed, especially on the downside. So we're starting to see that today. So what I would say is, I come back to the view that let's define this air pocket. I think we need to do that, right? So the way I think about long-term prices, we think, what does it cost all in, including all your capital costs, to produce a marginal barrel of oil globally? And we believe that is in and around $90 per barrel.
It's pretty high.
That's a long-term price. Now, because of the inelastic nature of supply and demand, and this is very inelastic because right now we're only off by about 1%. We're talking 1 million barrels on a over 90 million barrel market.
Not that much.
Not that much, but that's enough in an inelastic market to cause a step down, and you get into this air pocket of fear and speculation. And unfortunately, that stays one-word trajectory until the data starts to get better. So so what
are you watching for?
So right now, what we're watching for are two key things. Ultimately, we're going to remain in this air pocket of fear and speculation until we see marginal barrels come off the market. So the U.S., we're focused there. And secondarily, we can see the demand get better. And the cure for low oil prices is low oil prices. So this is as much as it hurts right now for the oil and gas companies, it is a dividend for consumers.
So how low could it go?
Right. So in terms of how low it can go, that lower end, we define it by the marginal cash cost. So ultimately, if you were to take everything away, just what to keep the lights on and bring a barrel to market, we believe the marginal producer is in and around $40 per barrel. So there could still be a step down. What we don't know is if the data starts to get better in between where we are today and $40. So when we think about how investors should be positioning portfolios, you need an all-weather portfolio to see through this valley for sure.
Now, we've seen a little bit of things like dividend cuts, CapEx. What are you watching for?
And those are the right things. We need to see those. So we're definitely looking. So capital budgets starting to get cut are quite significant. We've seen it in Canadian oil sands. We've seen it in ConocoPhillips. We're starting to see that start to happen. So capital discipline needs to be front and foremost, and we're starting to see those elements. And secondarily, we're also seeing, just at a very front cursory end, where U.S. drilling permits are down 40% month over month in November. So that's a positive sign. Now, what we ultimately need to see is rig count start to lower. But these are the right signals for the market.
So how low do you see this oil price staying here?
Right. So this is the
and how long?
So this is what I call the
the magic $1 million question.
Yeah, the $1 million question. And the way I would think about this is we need to. It's a range, right? Ultimately, we could see all the data start to play out in the next 6 to 9 months in a very near term scenario. But it could take all the way out to 2 years, right? So there's a period that has a range, and ultimately when you think about companies wearing through this, you need to look at that longer end of that range, the 2 years, because that's ultimately what this could play out to. But the one thing I will say is the equities will start to move before the commodity itself, because equity investors are ultimately looking at anticipating. So just as much as they overshoot on the way down, they'll be the first ones starting to pick up shares on the way back up.
And a lot of companies, can they move on a dime like that and pull back their CapEx and position themselves better?
We believe there are companies that are far better positioned to do that. All companies will say they can,
Okay.
But we believe when you choose companies that have a genuine track record of doing of high quality management teams that have capital discipline and have displayed that capital discipline. That's those are the you bet on the jockey that's done this before.
Exactly. So when you're positioning your portfolio, then what do you look for?
So it's first and foremost that capital discipline, history of a management team that we can trust their track record, and second, you need a good balance sheet. Like you go into this with it's the equivalent of going into a race with a great car, right? You need a great car, you need a great driver, so good management team, good a Ferrari type car, and the balance sheet is a reflection of that. And lastly, you need an asset base that's high quality and that's cash generative at today's oil price and maybe a bit lower.
So what's some examples?
Yeah, so we think there's a defined risk spectrum here, and I'll identify two key areas that I think are attractive where we sit today. And where we sit today is we don't know if it's going to be 6 months or out to 2 years. So we need companies that see through that valley. And the first bucket is the pipelines. We think that's a very attractive risk.
More conservative.
More conservative. There's limited to no exposure to the commodity price. But we've seen that universe step down with the overall energy space. And we think Enbridge is a fantastic name in that space. It's a 3.3% yield. They grew that dividend 33%. And going forward, we're probably going to see dividend growth in the range of mid-teens out to 2018. So this is a company that will ultimately be a beneficiary once the oil price starts to improve. But it's a lower risk dividend income way to play it.
All right. What about in the middle range?
Yeah, so the middle range is probably a higher risk, definitely a higher risk space, but also the rewards can be meaningful as well. And we think the best place to play in that area is with the large cap players, the companies that have displayed that capital discipline, through multiple cycles, and also they've got defendable balance sheets, right? So Canadian Natural Resources is we feel really fits solidly in that bucket. And when we think about looking into 2015, they've got a really flexible capital program. So depending on what the oil price is in mid 2015, this is a company that can really
pull back spending if they need to.
Yeah,
they can
absolutely. So when we think about the companies that are going to make it to the finish line and go to the next leg of development, Canadian Natural Resources is definitely one of those companies that stands well in that framework.
And you want those integrated players. What about the high end?
Yeah, so that's an area that I would avoid. So it's
highly levered, that kind of thing.
Highly levered, poor cash flow characteristics. These are companies that I would say that may not make it to the finish line, and I would just really beware of dividend yields, that may not come to fruition. So, these are sticker yields, I call them, and ultimately when you kind of go inside the office, you realize, hey, wait a minute, I won't actually get my dividend, and you may even see a dividend cut. So stay with companies that have proven track records. This is the spot we should be in today.
All right, we'll do our homework.
Appreciate it.
All right, thank you very much, Thomas. I've been joined by Thomas George, Portfolio Manager of the TD Resource and Energy Funds. Thanks for watching.